All right, let's talk about one of the coolest, most talked about ideas in finance right now, tokenized real estate. I mean, the whole concept is incredible, right? The idea that you could own a piece of a giant skyscraper and trade it just like a stock. But, behind that amazing promise, there's a really important question we have to ask.
So, imagine this. You've got a digital token, and it says you own a slice of some awesome building down in Austin. That's great. But what happens when you actually need the cash? What happens when you try to sell it? I'm not talking about a Tuesday afternoon when the markets are buzzing. I'm talking about 2 a.m. on a Saturday. Can you actually sell it then? That's the real stress test. And that's exactly what we're going to dig into.
Okay, so here's our game plan. First, we're going to look at the big promise, this idea of instant liquidity. Then we need a baseline, so we'll check out how the traditional world handles this with things called REITs. After that, we'll get into the tech, the whole digital deed concept. And then comes the fun part. We'll run our 2 a.m. liquidity test, expose a huge flaw that almost nobody talks about, and then, at the end, we'll put it all together into a new framework so you know exactly what to look for.
So, let's start with the why. Why is everyone, and I mean everyone, from tiny startups to the biggest names on Wall Street, getting so hyped about this? Well, it really boils down to fixing one of the oldest, most annoying problems with real estate. It's just so darn slow and clunky to buy and sell.
I mean, think about it. On one hand, you've got traditional real estate. Selling a house or a building, forget about it. It takes months. You've got lawyers, paperwork, escrow, and you need a mountain of cash just to get in the game. But the promise of tokenization, it flips all that on its head. The idea is to take that physical building, that concrete and steel, and digitally chop it up into thousands of tiny pieces or tokens. And these tokens, you can trade them in seconds on an exchange, just like you'd trade shares of Apple or Coke. It's about taking something totally illiquid and making it, well, liquid.
Okay, but hold on. Before we get too lost in all the cool new blockchain tech, we gotta pump the brakes. We need to understand how this problem is already being solved. Because, for decades, we've had a way to invest in liquid, tradable real estate. This is the benchmark. It's the gold standard we have to compare everything else to. I'm talking about REITs.
So, what's a REIT? The easiest way to think about it is like a mutual fund, but for buildings. It's a company, and its entire job is to own and run a bunch of income-producing properties. Think office towers, shopping malls, apartment complexes. And the best part? You can just go on a stock exchange like the NYC and buy a share of this company, just as easily as buying a share of anything else.
And the perks here are huge. First, they're run by pros, so you don't have to worry about being a landlord. Second, you get instant diversification across tons of properties with just one click. But the most important part, for our conversation anyway, is that they are super liquid. You can sell your shares any day the market is open and get your cash, right away. This instant access is the benchmark that tokenization is trying to beat.
So how does this actually work? How can a stock or a REIT be so incredibly liquid? Well, it's not magic. It's because of these specialized companies called market makers. Their entire job, all day long, is to stand in the middle of the market, ready to buy from anyone who wants to sell, and sell to anyone who wants to buy. They're basically the grease that keeps the gears of the market turning smoothly.
Let me break it down. Let's say you want to buy a REIT share. The lowest price anyone is asking is, say, $100.01. That's the ask. At the exact same moment, the highest price anyone is bidding to buy is $100 even. That's the bid. That tiny 1-cent difference, that's the bid-ask spread. And that's where the market makers live. They might buy from sellers at the bid and sell to buyers at the ask, and they make a fraction of a penny on each trade. But in exchange, they guarantee you can always find someone to trade with. That tiny spread is basically the small fee you pay for instant liquidity. Okay, so that's the old school way, built on stock exchanges and market makers. Now let's jump into the new world. How in the world do you take a real physical building and turn it into a digital token you can trade?
Well, let's look at a real-world example from some of Robinhood's earlier projects. When they offered tokenized assets, you weren't really buying a direct piece of the asset. You were buying a token that was basically a contract with Robinhood. They promised that the token's value would track the real thing. But here's the kicker. You could only buy the tokens from them, and you could only sell them back to them. See, this isn't an open public market. It's what you'd call a walled garden. Robinhood was the only game in town.
The whole point of all this tech is to create what you could call a digital deed. Instead of a dusty piece of paper in a government office somewhere, your proof of ownership is a unique token on a blockchain. It's all locked in with a smart contract. In theory, this is amazing. It's transparent, it's secure, and it's supposed to be super easy to transfer. That's the dream, anyway. All right, now we get to the heart of it. We've got the traditional, super liquid REIT on one side, and this new, theoretically liquid token on the other. So, what happens when we put it to the test? Our 2 a.m. stress test. This is where theory crashes into reality. Think about it. In a normal market for a big REIT, you've got thousands of buyers and sellers, all competing. That competition keeps the bid-ask spread super tight, like a penny, maybe less. But for a brand new token for a single building, who's going to buy it from you at 2 a.m.? Probably just the platform that issued it. And with zero competition, guess what? They can make that spread as wide as they want.
And this quote just nails the point perfectly. It's from a chat between professional traders, and one asks, hey, what's more liquid right now, stocks or Bitcoin? And the answer is instant. Oh, stocks for sure. Now think about that. If even a massive trillion-dollar asset like Bitcoin has worse liquidity than traditional stocks, what does that say about the liquidity for a token representing one single building in Austin? It's not even in the same league. So here's the takeaway. That bid-ask spread, it's the price you pay for the convenience of selling right now. In a liquid market, it's almost nothing. But in an illiquid one, that convenience fee can be massive. If you're trying to sell your $100 real estate token at 2 a.m., the spread might not be a penny. It might be a whole dollar. You just lost 1% of your money, not because the property value dropped, but just because you wanted to sell. That's not a fee. That's a penalty.
But look, a wide spread, that's only half the story. There's another, deeper problem here, a risk that I'd bet 90% of people invested in this stuff completely overlook. And it's the risk that the price you're looking at on your screen isn't even real.
No, seriously, think about it. A smart contract is just code. It lives on the blockchain, in its own little digital universe. It has no idea what's happening in the real world. It can't call up an appraiser in Austin and ask, hey, what's this building worth today? So, how does it know? The answer is something called an oracle. You can think of it as a bridge connecting the blockchain to the real world. It's basically a trusted data feed that pipes in outside information. The oracle is what tells the smart contract, hey, the latest appraisal for this building is X million dollars. The entire system, every single token's price, depends on that oracle being right.
And here's the brutal truth. If that oracle gets it wrong, if the data's old or biased or just plain incorrect, then the price of your token is based on nothing. It's a fantasy. The value you see on your screen isn't a real price discovered by buyers and sellers. It's just an opinion from the oracle. And if that opinion is wrong, your exit price isn't real. That is oracle risk.
Let's go back to that Robinhood example with tokens for private companies like OpenAI. It's the perfect illustration. OpenAI isn't a public company, right? So there's no public stock price. So how did they price the token? Well, the value is based on Robinhood's own internal appraisal of their stake in the company. In that setup, they weren't just the market, they were also the oracle. Yeah, let that sink in for a second. The source material says it, right there. The value of the tokens being entirely based on Robinhood's own internal appraisal. The same company you're buying from and selling to is also the one telling you the price. I mean, that is a massive conflict of interest, and it gets to the absolute heart of oracle risk. It completely undermines the whole idea of a trustless, decentralized system. Okay, so we've got these two huge risks on the table. Terrible liquidity and this oracle problem. So what do? How should an investor even begin to think about these things? We need a new way to look at it, a framework for asking the right questions. Let's just lay it all out side by side. With the traditional REIT, where does the liquidity come from? Deep, public markets full of competitors. How is it valued? By the real-time consensus of all those buyers and sellers. The main risk? The whole market goes down. Now, look at the tokenized asset. Where does liquidity come from? Often, just from the platform that issued it. How is it valued? By whatever the platform's oracle says it's worth. So you have these two new, huge risks. The risk of getting killed on the spread, and the bigger risk that the price itself is just plain wrong.
And that really brings us to the final, most important question you have to ask yourself. When you buy one of these tokens, are you really buying a piece of that apartment building? Are you betting on the Austin real estate market? Or are you actually making a completely different bet? A bet on the platform itself. A bet on its honesty, its technology, and its ability to provide a fair market when you need it most. That's the real question.